How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be taking a look at credit scores, what's happening with consumer credit scores. There's a couple of reasons consumer credit scores may potentially be going down. So we're going to look at a couple of articles here today, which we're going to jump into. So this first one, this is from the Wall Street Journal, and this was actually from the end of December. So it's a couple of months back, but still very important to what we're going to be talking about here today in this episode. So this is called "A Credit Score Hangover is Hitting America's Riskiest Borrowers." These borrowers are falling behind on payments after pandemic aid ran out and inflation skyrocketed. So Adriana Bashir's dream of homeownership seemed within reach for the first time in 2021. She and her husband Jeffrey were finally saving money thanks to pandemic stimulus tax checks and a larger than usual tax refund. A real estate agent suggested they work to boost their low credit scores before applying for a mortgage. The couple's scores rose after Adriana opened her first credit card and then vaulted into the 700s after the couple added 4 others. But as their savings dwindled, the 41-year-old mom started pulling out the plastic to pay for groceries and utilities. By October, the kitchen cabinets in her Fresno, California apartment were bare. All 5 credit cards were maxed out. Their balance has now exceeded $10,000. Adriana's credit score has fallen to 569. There are no more dreams of buying a house. I make more money than I did back then, and I'm struggling more now, she said. Americans' credit scores skyrocketed during the pandemic in an unexpected benefit of the upheaval. Millions are now nursing the financial hangover. So high prices and borrowing costs are hurting some of the same consumers whose credit scores were most inflated by the expanded COVID-era safety net. While the share of Americans seen as risky borrowers has dropped, according to credit scoring firm FICO, the credit scores of this so-called non-prime group have fallen sharply since last year, veering below pre-pandemic levels. People fell behind on credit card bills and car payments more often in 2024 than at any point since the aftermath of the Great Recession. We can see here average U.S. FICO score. It points out where the pandemic begins here in 2020. Basically hovering over 700. Maybe around. Like I said, somewhere between 705 and 710. But then we see that ballooning up to approaching about 720. Here at the top here over the last few years before coming down just a tad bit there. So. The boomerang effect is exposing a weak point in the U.S. economy that has earned widespread discontent in recent years, despite muscling ahead of its rich peers. Credit scores, ranking of consumers' likelihood to repay debts, serve as most Americans' primary gauge of financial health. Their rise during the pandemic fostered hope for young families of home ownership or new cars, but for those whose incomes haven't kept up with inflation, the normalization of the economy has meant backsliding. Somehow, some are now living with loans they wouldn't have been able to otherwise obtain and credit limits lenders wouldn't have typically offered. The swings show the sometimes arbitrarily seeming ways that credit scores shape Americans' lives. They are ubiquitous, assigned to people without their say, even without their knowledge, yet they are a government program like Social Security. Instead, they are based on a system pioneered in the 1950s by Bozeman, Montana-based Fair Isaac Corp, known as FICO, and monitored by a handful of private companies. Debt counselors across the country say their client books are equal to or exceed the numbers in 2019. Lenders catering to low or middle income people have taken a hit. Non-prime borrowers monitored by FICO in April spent 13% more of their credit lines on average than when COVID-19 landed, while falling behind on bank card payments in the past year, 28% more often. For the past 4 years, we've been waiting for the other shoe to drop, says Laura Casarelli, a credit counselor for American Financial Solutions. We're finally hitting that stage. So, and then it said, after jumping from 708 in April 2020 to a record 718 in April 2023, America's average FICO score ticked 1 point lower in October of 2023, the first decline in a decade. It has held steady since then. Economists say that downshift isn't steep enough to signal a slowdown in overall consumer spending or trigger instability in the financial system. Total delinquencies are still low by historical standards. Instead, the slip reflects pressure that is disproportionately hitting people on the lower extreme of the credit spectrum. And then it kind of goes in there. So yeah, it just kind of talks about that, getting into the lower end of the spectrum, continues the theme of what we saw there. This is some interesting charts here. Americans who took on debt in 21 and 22 are further behind on payments. I don't think that's really shocking there, but it just shows you how, particularly credit cards and auto loans have become more delinquent. We're going to take a look at student loans in a second and how that's also playing a role in here on people's FICO scores. So nothing, basically nothing major on the surface, but there's definitely some things rippling below the water, so to speak, right now. So, all right, let's take a look at a couple other things here real quick. And both these articles play into each other. So this was just as of a couple days ago, March 26th. So this was from Investopedia. And this was credit scores of more than 9 million student loan borrowers will likely drop in the first quarter. So more than 9 million student loan borrowers will likely see their credit standing significantly diminish in the first quarter. During the COVID-19 pandemic, payments were paused. And until February of 2025, missed payments didn't harm borrowers' credit scores. However, as 4 cohorts of recent grads enter repayment for the first time and court battles impact income-driven repayment plans, delinquent and defaulted student loans are expected to rise higher than in pre-pandemic times. So, yeah, so interesting thing there. So now we're going to jump into this third article from the Wall Street Journal. And this is steep drop in credit scores hits student loan borrowers. About 43% of those who owe payments haven't resumed making them yet. So Americans with student loans are waking up to the reality that skipping payments comes with consequences again. The pandemic era relief on federal student loans ended in October, starting the 90-day clock people have to make payments before their credit scores take a hit. Now that time is up and borrowers are feeling the pain. Shiloh Garcia was notified by her bank this month that her credit score had dropped from 720 to 620. She discovered she was more than 90 days delinquent on payments for her $16,000 in student loans, which she had thought were still suspended. Her mortgage broker estimated the lower score would add $400 to the monthly payment for the new home she wanted to buy. I'm devastated, said Garcia, a 39-year-old nurse in Modesto, California. It's like having your whole life put in limbo over a simple mistake. About 43% of borrowers who owe payments on federal student loans haven't resumed making them, according to analysis of government data by VantageScore, a credit score provider. That put more than 9 million people at risk of a serious credit score drop, with 2 million of those on track to fall into subprime status. The setback could have ripple effects throughout the economy, putting homeownership or a new car further out of reach for late payers who are largely ages 25 to 50. Lower scores can also mean lower credit card limits and higher rates, which could be a drag on consumer spending, a crucial engine of the U.S. economy. Borrowers cite a mix of reasons for not resuming payments, including confusion over their loan status and inadequate communication from loan servicers, the companies that collect payments on behalf of the government. Some say bill reminders were sent to outdated home or email addresses from when the COVID-19 pandemic started. Ben Kaiser, a spokesman for loan servicer Nelnet, acknowledged the concerns from some borrowers about communication, but he said in a written statement that, like any credit card, auto loan, mortgage loan, or consumer loan, it is ultimately the borrower's responsibility to ensure their loan servicer has accurate contact information. The student loan saga began in 2020. We all know. Then there was reprieves that came in. And then this is an interesting chart here. How much do borrowers owe? So for a lot of people, basically they owe less than $5,000. Basically, there's about 30 million people out there that owe anywhere from $5,000 to $60,000. Probably about 6% owe anywhere from $60,000 to $200,000, and basically about 1% probably owe more than $200K. So basically that's your doctors and lawyers out there that have these, doctors, lawyers, MBA students, like people who have done post-grad, education. They're the ones that mainly have these much larger, balances, which again, makes sense because when you think about the numbers, I mean, only about 4% of the U.S. population has a doctorate, about the same for a law degree, a little bit higher on the MBA. But again, I mean, you're definitely talking less than 20% of the population has advanced degrees. So nowhere near as much as people think. Someday I'm going to have to dive into the just the edge. I find the education numbers themselves to be very fascinating. Like people think that I think people have this conception that most of the people in the country have a college degree, when in fact it's only about 30% of the population has an actual, like 29% has an actual college degree. And then when you go to people beyond college degrees, it's a much smaller percentage of people that have, you know, graduate degrees. So that the kind of the well-educated credential class, if you will, is a much smaller group of people that I think people, just because of advertising, pop culture, things you see in the news, I think people have a much more inflated idea of how many people are true. I think people get this impression that like 90% of the country has a college degree, which is just absolutely not true. But anyway, so to get back to this for a second, so and again, it kind of caps up by saying like, okay, borrowers are basically responsible and need to be on top of things, whatever. So, but again, I find this interesting from a perspective of, obviously, credit card debt has ballooned, auto loan debt has ballooned, student loan debt has, all types of debt have ballooned. The student loan debt thing is just, it's very interesting because of the roller coaster, if you will, between having, payments put off and then put back on, and then having all these things for like, well, you've got some other reprieve. So even if you're not making the payments, we're not going to report it to the credit bureaus, or we won't consider you delinquent, or maybe they're very lenient with like working out what are called like forbearance agreements and things like that, letting people slide on payments. Well, a lot of that is now stopping, and now it's just getting back to good old fashioned, hey, you got a debt, here's your monthly payment, you got to make the payment. So that's going to have effects on a lot of people, and so what is that? And that's kind of a question I've asked for a while, is what do those combined effects look like with people having taken out a lot more credit card and auto loan debt? Now you're adding the student loan debt on top of that. We got a lot of people in this country that are going to be hurting. But I think bigger than that, even if you're struggling in that, that's going to delay people from what? It's going to delay people from starting families, from buying houses, from kind of getting on with their life, so to speak. So, there's no magic answer. There's no silver bullet for that. There's no magic answer. A lot of people just, they have to, and this is why like financial literacy becomes so important in the country, right? We have to have more financial literacy. We have to teach people about, what kind of debt are they taking on when they go to college, and how to use credit cards appropriately, and all this very important stuff. So, but with that, I'll wrap up and say, hey, we'll continue to keep an eye on this and see what happens. If there are any major updates in this with credit scores, or credit score calculations, whatever the case may be, I will let everybody know, and I will bring that back. But with that being said, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. I hope everyone has a wonderful day out there, and I will see everyone again real soon. Thanks a lot.